This is Chapter 9, Part 3, Plant Assets. We're going to be looking at the procedure for revising periodic depreciation and distinguishing between revenue and capital expenditures. So the following slides are to show you how we would treat partial year depreciation expense. And we're going to be referring back to our spreadsheet in your handout. You're going to need that for reference. So as a review, Lawrence the florist purchased a small delivery truck on October 1st. Now we've changed the facts just with respect to the date. In the one we just did in the last video, we had the purchase date of January 1st, beginning of the year. That made it very simple because when we booked depreciation, we were able to book it for a full year. For straight line, we knew from our calculations that we would be booking $2,400 a year, $2,400 a year. Because this is a partial year, and October, November, December are 3 months, we would take that $2,400 and prorate it just for the 3 months. So in that current year, it would be $600. For the next 4 years, it would be $2,400. And then we would go into 2016, but only for 9 months to take us to the 5th year. And that would also be a partial year. So for the first year, you'd only book 3 months of depreciation. Now for units of activity, partial year depreciation is just not a problem because again, you're just checking the actual usage. So we probably wouldn't have 15,000 miles for only 3 months, but we'd have a smaller portion of that. And we would continue to go into 2016 until we'd reach the 9th month. So I'm not going to demonstrate that one. Let's go on to declining balance depreciation for a partial year. You would calculate it for the first year, the $5,600, and then prorate it 3 months. This would take you here. Then you would have 5,000 as calculated. Now that declining balance is going to be higher because we didn't write off the full 5,600, and then you just roll it forward. And so in this example, we do go out to the 2015, but again, we don't have to go into 2016 because we have already reached our salvage value. Depreciation and income tax. One of the things that's always a surprise to students is that yes, you actually can have 2 sets of books. You can use different accounting methods for your tax return. When you fill out that 1040 and you is the company would have a different depreciation method for tax purposes than they do when they prepare financial statements. The IRS requires straight line, which you could also be doing for your financial statements, but they do allow alternative methods, such as modified accelerated cost recovery, which is another form of an accelerated method, in the same way that declining balance is an accelerated method. Makers, it's called Makers, M-A-C-R-S. Makers is not acceptable under GAAP. All right, what happens when you have an asset and you say, golly, we're in this asset 3 years, and now we think it's actually going to have a 6-year life instead of a 5-year life? You are allowed to change estimates. The way it's handled is you don't go back and restate your financial statements. You do it on a go-forward basis. In other words, in the current year, you use the new method and you use the new estimate, and for every year forward you do. It is not considered an error. So let's take an example. Let's look at your straight line handout and let's go out to the year 2014. Actually go to the year 2013 and look at the book value of your asset as of 2013 end of the year. And your book value of that asset is $6,800. So what do we do with that? We would say now we want to extend the life 1 year. We think this asset actually has a 6-year life, not a 5-year life. Well, 3 years have already passed, so you've got 3 more years left. What is the journal entry to correct the prior year? That was a trick question. There is no journal entry because we do this on a go-forward basis. So what is the depreciation expense for 2014? Well, you take the current year book value as of January 1st, which is $6,800. You back out the salvage value, and then you say the depreciable cost left on this asset is $4,800, and we're going to divide it by the remaining 3 years. Now, if we'd stayed with our original estimate, the remaining years would be 2, but we've revised it to 3 years. So our annual depreciation is $1,600. And it had been $2,400. So you can see that by making the life of the asset longer than originally planned, you're going to take a lower expense on this asset. And that would be your journal entry going forward for straight line for the next 3 years. Now here's a caution to you. When you make the decision to extend the life of an asset, you reduce your depreciation expense. When you reduce your depreciation expense, profit will go up. So, an auditor is going to ask you, what is the rational basis for extending the life of this asset? If you don't have a good explanation, they're going to have you correct this, because what you've done is you've perhaps artificially overstated profit. Let's move on. During the life of an asset, you may have the occasional repair. For example, with a truck, you would have an oil change, or maybe a brake alignment, or some sort of thing, or a tune-up for it. This is considered an ordinary repair. These are expenditures to maintain the operating efficiency and productive life of the asset. You know, this is something you have to change your oil. My husband tells me you have to change your oil. So what do? You debit. You get a bill for an oil change, $50. You debit repair expense and credit cash. And this is called a revenue expenditure, and it's reported on the income statement as an ongoing expense. It's a regular expense. What happens if you do a major repair? What happens if that major repair actually increases the operating efficiency, productive capacity, or even the useful life of the plant asset? Well, let's say you dropped a new engine into the truck. Now you've done something significant, and that's really going to extend the life of that truck. You would debit the plant asset, so you debit equipment and credit cash. You've actually increased its efficiency, and you wouldn't have to expense this up front. You would write this off over the life of the asset. And as I just said, fraud alert, revenue expenditures reduce profit in the current year. Capital expenditures reduce profit through depreciation expense at a much slower rate. So auditors are always very interested in what the company considers a capital expenditure. They are always careful to scrutinize these expenditures and make sure they're valid, if they're true capital expenditures and not revenue expenditures. This concludes part 3. Please go on to part 4.